Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Shell Midstream Partners stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Shell Midstream Partners owns, operates, develops, and acquires pipelines and other midstream assets. The company is headquartered in Houston, Texas, and was founded in 2014. It went public in 2014 and currently trades on the New York Stock Exchange. Its assets include pipelines and terminals that transport, deliver, and store crude oil and natural gas. It is an MLP, Master Limited Partnership, which means it does not pay income taxes. To qualify, the business must receive 90% of its revenue from natural resources or real estate. The company was formed by Royal Dutch Shell, which owns 69% of SHLX. Let's get started with the model. This is a mid-cap company, $5 billion market cap. They're trading at $13 a share, and they have 393 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has positive and growing free cash flow each year. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they also have growing net income each year. Revenue is a sales for the company. That's pretty steady. It peaked in 2018 at $525 million, but came down to $481 million in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and the difference is the gross profit. And their gross profit is pretty steady, around $400 million a year. Below that is operating expenses, then operating income. They do have their lowest operating income in 2020. That's mainly due to lower revenue and slightly higher operating expenses. Below that is the interest they pay in their debt, then other income and expenses. That gives them a real boost, other income and expenses. Most of the dollar amounts in other income and expenses are earnings from equity interest. This is earnings from its investments in other companies. Then the bottom line of the income statement is their net income. And they do have the highest net income in 2020 due to the high other income and expenses. But they have a lot of net income relative to their revenue. In 2019 and 20, their net income is higher than their revenue. That's not common. The reason is because of other income and expenses. I would focus on operating income when I look at the company's income statement. That's more applicable to the company's core business. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. This is a better indicator of a company's financial health than net income, because net income is your accounting profit and loss. It's not actual cash. To find out how much cash the company generates, you need to look at the statement of cash flows. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And the company has a lot of free cash flow left over. So since they have consistent free cash flow, they're able to pay a nice dividend each year. They're also issuing capital stock, $300 million in 2017 and $1 billion in 2018. When a company issues capital stock, this increases the shares outstanding, making your shares less valuable. They're also issuing a lot of debt, $1.7 billion, then $1.8 billion, then $600 million. They did pay down $500 million of debt and $1.6 billion of debt. If a company has a lot of free cash flow and they're issuing stock or debt or both, chances are it's because they're trying to acquire another company. Let's look at the capital structure. They have negative $481 million of equity. That means their liabilities are $481 million more than their assets, and $2.7 billion of debt. So they're 100% debt since they have negative equity. And their WACC is 10.86%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that $6.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6.4 billion. We divide that by 393 million shares. And we get a calculated stock price of $16.30. They're trading at $12.74, so they're trading at a 22% discount. It's a buy according to the model. Simply Wall Street's at $20 a share, so they're saying the stock is even more undervalued. This is the stock price since it IPO'd, and you could see it's only gone down because oil and gas stocks have gotten hit pretty hard, especially with the whole EV boom. But I have a good feeling a lot of oil and gas stocks will go back up because oil and gas is not going away anytime soon. This company raises its dividend each year. It was 24 cents and it nearly doubled to 46 cents. They have a great dividend payment, 14.5%. To calculate the dividend payment, you take the most recent dividend, multiply by 4, then take that number and divide by the stock price. They pay out 130% of their net income and 116% of their free cash flow. Now it becomes clear why the company may have added some debt to pay their dividend payment. This company has a beta of 1.63, so the stock moves 1.5 times the market. It's a bit volatile. The stock has gone up 16% in the past 52 weeks, while the S&P 500 went up 40%. The 52-week low was $6, the high was $16, and the stock is trading above its 50-day and 200-day moving average. About 2 to 2.5 million shares are traded each day on this stock. Of the 393 million shares outstanding, 124 million are on float, 28% are held by institutions, and 1.5% of the shares are shorted. If you invested $10,000 into this company in 2014, you'd have $5,800 today. Not a good return on investment. Their parent company, Royal Dutch Shell, owns 69% of the stock, then Alps owns 4%, then Tortoise, Chickasaw, and Neuberger. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 9.2, so investors are paying $9.20 for $1 of earnings. Price to sales is stock price over sales per share. They're at 10.4, which is worse than the median and average. Price to book is stock price over book value per share. They're at -10 because they have negative equity. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments more than 2 times. ROE is net income over equity. They have negative equity, so we can't look at the ROE. Current ratio is current assets over current liabilities. They have a lot of current assets on their balance sheet, and their current assets are $320 million of cash and $41 million of receivables. So the company is well capitalized. They had $600 million of free cash flow, over $300 million of working capital, but they do have that $700 million dividend payment. So they have $200 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 45 midstream companies. The average of those companies is right here. Shell is right here. Shell has a worse PE ratio, price to sales and price to book. They have a really high current ratio, much higher than average. They're 100% debt. They're smaller than the average company in terms of market cap, but they do pay a high dividend, over 14%, average is 10.5%. So to summarize, I have them trading at a 22% discount. Midstream companies are a very important part of the oil and gas process. Those companies are not going away. Some may go bankrupt, but the industry is too important right now. So many cars rely on gasoline, airplanes rely on gasoline, plus the many other things that rely on oil and gas. In addition, this company's parent, Royal Dutch Shell, is a giant oil and gas company, one of the biggest in the world. I ranked their free cash flows 8 out of 10, their revenue 5 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.